Now we're going to look at the income statement. So the income statement measures the income for a specified period of time. Now, revenues increase income and expenses decrease income. I'll just point out that revenues are going to be credits and expenses are going to be debits. And the reason for that is that the income statement is part of owner's equity. So I'm using this just to say a subset of owner's equity. Expenses come in two flavors. They can be either product costs, which are called cost of goods sold on the income statement, or they could be period costs, which are just usually labeled as expenses on the income statement. Now, the income statement is a temporary account. And what that means is that the balance is zero at the beginning of each accounting period, and then we transfer the ending balance to retained earnings at the end of the period, once again setting the balance to zero. Remember, this is pretty important, right, that the income statement is closed to retained earnings. That just means the balance is transferred to retained earnings, and I'll repeat it since students sometimes have a hard time with this, that revenues are credits and expenses are debits, and that's because the income statement is an owner's equity account. So here are two T accounts, one for the income statement, which I call the income summary T account, and one for retained earnings. We start off with the income summary having a zero balance, and that would be typical at the beginning of each accounting period. Now let's say we had a sale on account. So we would have a debit to accounts receivable, and I'm going to use a credit to the income summary account or sales revenue for $52,000. If I put the credit to sales revenue, that doesn't matter because it would still show up on the income summary account. So notice that the credit increases income summary, and since income summary gets closed to retained earnings, it would have the impact of increasing owner's equity. Now, how about cost of goods sold? Well, cost of goods sold would be a debit to the income summary because it's a product cost, right, and a credit to finished goods inventory, but I'm not worried about that. Notice that the debit means that it decreases income, which means that it would decrease owner's equity. Now, let's suppose we had various operating expenses, and once again, that would result in a debit to the income account and credits to things like cash, accounts payable, etc. If those were the only two sets of expenses we had, we could now calculate an income number, and the income number would be the balance in the income summary account. Well, the income summary account has to go to zero, and since we have a credit balance, that indicates we have positive income. If we had a debit balance over here, then we would say we had a net loss. So what we want to do now is transfer the balance from here to there. And the way to do that is with a debit to the income summary and a credit to the retained earnings. And notice now that the income summary account goes back to zero and the retained earnings account has been updated to reflect another period of earnings.